What's up, everyone? My name is Ale, and welcome back to my world of stocks. So, Netflix just released their second quarter earnings, and Wall Street didn't like the results, and the stock tanked by over 10% in a single day, and it is currently down by almost 15% just in the past week alone. So in today's video, I want to take a look at the stock, the company, their business, their performance, their future potential, and the increase in competition to see if this stock is worth buying at these lower levels. I hope you guys enjoy this video. Let's go ahead and start by pulling up the stock chart, and then we'll transition to their business financials and performance and their most recent earnings. Okay, so as you can see here, the stock tanked by over 10% after those earnings, and it's currently down by over 14% in just the past 5 trading days. This also leaves them down by over 17% from their 52-week high, which they currently sit at just a little bit above the midpoint of that range at around $320 per share. However, if we zoom out a bit, we can see that this is a stock that is still up enormously over the past 5 years at over 400% gain, so it's really a stock that has been absolutely on fire in recent history. And this has led to a very rich valuation with a massive trailing PE ratio of 128. That does, however, drop all the way down to 55 forward, as they're expected to see high earnings growth in the future, but even their PEG ratio, the price to earnings to growth ratio, which is probably the most forgiving metric for high growth stocks, still sits at over 2.1, which is not exactly cheap. Generally, we want that number to be a little bit closer to 1 if we can get it. And Netflix is the type of company that really needs to reinvest in their business in order to stay competitive. So their profits will therefore be limited, at least in the early stages of this new video on demand streaming market, but even then they're still trading at over 8 times sales, so it's definitely not a cheap stock or even one that I would consider affordable. However, what Netflix does have is again very high growth. When looking at the past 4 years, they've grown their sales from $6.8 billion in 2015 to almost $16 billion in 2018, and when looking at the next couple of years, they're expected to reach $25 billion in 2020. As a growth percentage, you're talking about 35% growth last year, 28% this year, and 24% next year. Now, when talking about their profits, it starts to get a little tricky because Netflix is technically a profitable company, as they've grown their net income to over $1.2 billion last year, which was year-over-year growth of 116%, but this is one of those times where net income is a metric that isn't very good for representing true profitability, since Netflix uses amortization in their accounting to spread their very high production costs across several years so that they can still at least appear to be profitable. However, because the cost of producing their own original content is so high, which they continue investing in so that they won't have to pay those huge licensing fees to their competitors like Disney and Time Warner to use their content in the future, they've actually reported negative free cash flow that continues to get bigger and bigger, reaching almost $3 billion in losses last year alone. So while Wall Street is expecting huge earnings growth of 28% this year and 71% next year, giving them much lower forward PE and PEG ratios, the fact is that Netflix is a company that continues to lose billions of dollars a year, and even with that 28% earnings growth this year, they're still expected to lose even more cash, this time by as much as $3.5 billion. Again, this year alone. So not only is Netflix not really profitable, but even if we use their more favorable metrics, they still come up massively short against most of their competition. Their trailing PE ratio is around 6 times larger than the sector median and insanely higher than all of their competition, even including Amazon, which is notorious for being one of the most expensive popular stocks out there. And even with their enormous growth, their forward PE ratio is still much higher than the rest at 55, while the sector median is less than half, Amazon is still lower, and huge companies like Disney, Apple, and AT&T are only a fraction of that by comparison. Not to mention that most of these companies even pay some really nice dividends as well, which is something that you won't get from Netflix. And if we look at how much they bring in sales, it's not even close, as Netflix looks like an ant in comparison to most of them, and the same goes for their free cash flow, with most of these companies bringing in tens of billions of dollars a year, while Netflix is still in the red. Don't get me wrong, I fully acknowledge that Netflix is a much newer company than most of these, and they were really the first to practically create the entire video on demand streaming market, with most of these companies coming in now just kind of trying to copy them. But I just can't ignore the fact that you can pretty much pick up any of these gigantic companies that have huge cash flows, they're very profitable, and some of them even pay some very nice dividends for a fraction of the price of what you're paying for Netflix. To be fair, Netflix does have some very high growth rates that are usually higher than most of these companies, but even then, I think you can still get some pretty nice growth stocks for a much cheaper price. And just some that come to mind would be like Google and Amazon and Facebook. And these are companies that are insanely profitable with some very nice balance sheets as well. We'll take a look at Netflix's balance sheet a little bit later in the video. But I actually even just made a video on some high growth stocks. So if you want to check out some more growth stocks, I'll have that linked for you down in the description. But as it stands right now, Netflix needs to continue to reinvest heavily in their growing business to build up this catalog of content to compete with these giant companies that have huge backlogs of original content already. But when looking at subscriber numbers, none of these companies are really close to what Netflix has in terms of subscribers or a subscriber base, because a lot of these companies haven't even launched their competitive streaming products yet. So let's now transition to Netflix's subscriber numbers. Let's also take a look at their earnings. And then we'll also talk about the market, how much potential there is in the future. And we'll also take a closer look at that competition. And then I'll finish the video with my overall conclusion. So let's go ahead and do that now. Okay, so taking a look at those earnings, we can see that they beat on EPS by 4 cents, and their revenue barely missed at 4.92 billion reported versus 4.93 billion expected. But it was still up by 26% year over year, which is again very high growth. So financially, it was a pretty good earnings overall just based on sales and EPS, but their subscriber gains were very disappointing when compared to expectations. In the United States, they were expected to gain over 350,000 new subscribers this quarter, but they actually lost 126,000 subs. So, they were expected to gain subs, they actually lost a ton of subs. And while they did gain 2.83 million new subs internationally, which is where they have the most growth potential, it was still much shorter than the 4.81 million that was expected. So pretty much by almost 2 million subs, they missed those expectations. Still, this now puts them at over 151 million total subscribers, which is up by over 21% year over year. But when you're a stock that is trading this high, you have to either meet or exceed expectations, otherwise the stock is going to get hammered, and that's exactly what happened. And when looking at the reasons for the miss, Netflix blamed that on not having enough strong content in the second quarter, which was coming off of a very strong first quarter that was difficult to follow. Also noting that the weakest regions were also the ones that saw prices increase, meaning that subscribers may not be as willing to pay these higher prices like everyone was predicting, especially when you're actually losing a ton of your licensed content. I remember everyone saying that Netflix has a ton of pricing power, and I just don't really agree with that myself, because you have major competition entering the space now, so pricing and content is going to be very important. Looking forward to the third quarter, Netflix does expect things to get better with 7 million new subscriber adds due to stronger contents like new seasons of Stranger Things, Orange is the New Black, and The Crown. However, it's expected that hit licensed shows like The Office and Friends will be leaving the service over the next couple of years, with The Office moving to NBC's streaming service and Friends moving to AT&T's new service called HBO Max. A big deal when you consider that most of their viewership actually comes from licensed content. Back in March, Forbes published an article that claimed that 63% of viewership actually came from licensed content versus anything that Netflix had created themselves. And if we take a look at the best performing shows last year, we can see that 8 out of the top 10 shows were licensed from either Disney, AT&T, or Comcast, who are all launching their own competitive products very soon, with The Office and Friends taking up the top 2 spots. And again, both of those are already confirmed to be leaving Netflix. To be fair, this will open up an enormous amount of money that Netflix can spend on creating their own original content rather than licensing it from competitors, but the point remains that older backlog content is still the most popular with viewers, and pretty much all of it is owned by these huge competitor companies who also happen to have massive budgets for creating new original content as well. Disney recently acquired most of 21st Century Fox to beef up both their Hulu platform, and they'll also be releasing a new platform called Disney Plus later this year for a cheaper price than Netflix at a $7 launch price versus Netflix's standard price of $13, so it's much cheaper than Netflix, and it'll include both old and brand new content from Star Wars, the Marvel Universe, and all sorts of other huge studios and brands like all of their Disney backlog, Pixar, and even National Geographic. Their Star Wars Mandalorian show alone is said to have the same budget of Game of Thrones, actually the last season of Game of Thrones, so it's actually a huge budget, and that's again huge budgets for original brand new content. AT&T also acquired Time Warner to create an all-new platform called HBO Max, which is set to release early next year, and while it is expected to be around $3 to $4 more than Netflix, it will also come with an enormous amount of content from HBO, Warner Brothers, New Line Cinema, the DC Universe, CNN, TNT, TBS, Cartoon Network, Crunchyroll, and a lot more. So that's a ton of content as well. And that's not even mentioning other services from CBS, NBC, Apple TV Plus, and even Amazon that bundles their Prime Video with every Prime membership that already totals over 100 million paid members just in the United States alone. Granted, there should be plenty of room for multiple competitors to exist in the space, given that the market is worth about $25 billion according to Statista, and has so far been growing by billions of dollars every single year as more and more people continue to cut the cord and switch over to cheaper video streaming services, but you're still talking about giant competitors that are not likely to back down. And their enormous cash flows will make it very hard for Netflix to compete, not to mention how poor Netflix's balance sheet is, with less than $6 billion in current assets, almost $7 billion in current liabilities, and over $12 billion in total long-term debt. So their current assets can't even cover their current liabilities, let alone the massive $12 billion of long-term debt that is pretty much double their current assets. So I just can't really see myself investing in Netflix at this time. Now, you could definitely argue that I'm a bit biased because I do already own Amazon, I own Disney, and I also own AT&T, and they're huge positions in my portfolio, but they also give me a lot of exposure to this market already. So if you ask me to pay a premium price for Netflix over these other giant companies that are much more diversified, have huge cash flows, some of them even pay dividends, and they give me a ton of exposure to this market already, then there's just no reason for me to do that. But to be fair, I've been bearish on Netflix for a very long time, and I've been proven wrong almost every single time. I mean, again, this is a company or a stock that is up by over 400% in just the past 5 years. So clearly, Wall Street does like something about Netflix, and again, it's probably the high growth and the future potential. So if those are two things that you're really interested in, then maybe this is a stock that fits for you. But for me, it just doesn't make any sense, and it's definitely a stock that I have no interest in buying at this price, or even, I don't know, like it would have to be cut like in half just to get me interested. And I know that sounds harsh. I'm not trying to be overly critical on Netflix. I know that a lot of my viewers are invested in Netflix and they really believe in it, and I think that's great. I wish you all the best. I really hope that I'm wrong, and I probably will be wrong because I've been proven wrong many times on Netflix stock already. And I'm not someone who likes to short stocks, but even if I did, I still would not short Netflix because it is a stock that has a very big following, and a lot of people just seem to really believe in it, and they really like the story of Netflix. So it's not a stock that I would be willing to short. It's a stock that has performed very well in recent history, so I'm just not really interested in trying to bet against that. But in terms of where my money is going to go, I'd rather put it into these other companies. And a big reason for that too is because, and this might be kind of biased again, but it's because I just don't really believe in Netflix's product anymore. I used to have the Netflix membership for many years, but I ended up canceling it recently because I just got so bored of the content. And for me personally, again, I'm probably in the minority of this, but I just don't find any of their original content very appealing. And now that they're losing a lot of their licensed content, and when they started canceling all the Marvel shows as well, which was something that I was really into, it just didn't appeal to me anymore. So when I think about what my future setup will be in terms of video on demand streaming, I'll probably have a setup of HBO Max just because it has so much content in it, and then I'll probably add to that Disney Plus because I'm a huge Star Wars fan, I'm a huge Marvel fan, and it also gives me access to some other stuff like National Geographic and several others as well. And then on top of all of that, I still have Amazon because I'm a Prime member, so that instantly gives me access to Amazon Prime Video. So that'll probably be my setup in the future, and that's not very expensive, but it is a few different options, different platforms there, so that does drive up the cost a little bit. So I just don't really see the reason to add to that with Netflix. So I probably will just keep Netflix out. I may go back to it a couple times to check out what original content they have and just kind of stream that for like a month and then probably cancel, but it's not something that I can envision having long term. Whereas with the other ones, I can definitely envision having those long term. But anyway, that's my thoughts on all of this as a long-term investor thinking out into the future. That's just kind of the way I see it, and I'd rather have those other companies. But anyway, let me know what you guys think. I'd love to read your thoughts and comments down below. I hope you guys enjoyed the video. If you did, make sure you hit the like button. It really helps the channel a lot. It really means a lot to me. And I'll catch you guys in the next one. Take care. Bye-bye.